welcome everyone. Tonight we're going to talk about saving for children's education. So whether it's your own child or your grandchildren or whoever you like, we're going to talk about that tonight. I'm going to share my screen with you here right now. There we are. There we go. Okay, so saving for your children's education. And as Sam has already mentioned, feel free to type your questions in, whether it be on this particular subject this evening or on if you've got burning questions from some of the subjects we discussed in our earlier sessions. I'm happy to take any and all of them. And again, as per usual, this is my contact information, so you can make a note of it or take a picture of it with your cell phone. It will also be at the end of the session. If you've got questions and you're just too shy to type them into the question box, or you want to talk to me personally, feel free to do so. It's not going to cost you anything to do that, so take advantage of it. There was a article that came out today from the Financial Planners Standards Council here in Canada, and it said that 1 out of every 3 people is more concerned about their finances today than they were a year ago, and 1 out of every 4 has not been able to save for the futures in the last 12 months. So I'm paraphrasing that, but that's roughly what it said. So I think these sessions are timely, and hopefully you find them beneficial and will help get you started on the right track. Because we do a lot of these sessions for group employees and employers. This is just kind of the disclaimer, if you will, tell you what we're here to do. And my role today is to educate, and hopefully, if I do it right, maybe a little entertainment as well. Try not to make this too dry and too boring. So tonight, we're going to discuss why saving for education is important, what registered education savings plans, or RESPs, are, what the Canada Education Savings Grant is, and how you can also use tax-free savings accounts for the same purpose. So you're going to get a few statistics like you always do in these sessions. So tuition for undergrad programs for Canadian full-time student was on average about $6,500, $6,600 almost in 2017, 2018. That depends, of course, on which university or college the kids attend and in what part of the country. It varies drastically by regions. I know my youngest daughter's in university out in Nova Scotia, and it's considerably more than that. So in between some provinces, there is a non-resident fee that you pay as well. So if you're in the province of Alberta and your kids go to school in Alberta, you won't pay that non-resident fee, but there are some fees. So if you've got your students living at home, then the estimated cost of a 4-year college or university degree is currently about $24,000. If your child is 5 years old, and so it's going to be a number of years, or years until your child attends post-secondary is going to be 5 years, 10 years, or 15 years. You can see what those numbers are going to equate to, given the inflation rate and a assumed 4% increase in educational cost. And so that's the kind of savings that you're going to require if you want to fund those education needs for your children in full. So if your child's under 5 years old now, 3 years old, because that puts them 18 and 15 years, you need to consider starting to put away $200 per month per child if you want to reach those goals. Interestingly enough, the number to fully fund and receive the Canada Education Savings Grant is just a little over $200 a month. So if you start there, you'll take advantage of all the grants as well. We'll talk about that as we're going along. Students living away from home, then you can see the costs skyrocket considerably. Education is a significant part, the education tuition is a significant part of going to school, but there's a whole bunch more involved, and that's room and board, and of course transportation and all the rest of it. So if you're going to send your child away to Nova Scotia to university like my youngest is, then you've got to save $100,000. So you better get on the stick and start putting away about $600 a month right now. So what do you suppose has risen faster over the past number of years, tuition or inflation? Tuition has risen faster than inflation. Why inflation averages about 1.6, or we always figure 2% in this industry, tuition fees have increased by 3.1% from the previous academic year, and that's in 2017, 2018. Again, and I hate to keep harping on what we've been through for the last 12 months, but those costs are very likely not going to decrease and very likely not going to slow down. So you may not be able to be in a position to fund your children or grandchildren's entire education post-secondary, but if you can make a dent in it, it's going to help. And that's really what we're here to talk about, is just to try and assist. The pie in the sky ideal is to be able to fund it all, but not everyone's going to be able to do that. So like everything when it comes to financial discussions, it's all about compounding, right? So if the sooner you can start to put money away, time is on your side. So if you started today with $100 a month and you've got 18 years to put money away, and assuming a 5% rate of return, you're going to accumulate roughly $35,000. If you wait until that child has only got 9 years before they start their post-secondary, then you're going to put away significantly less than that, but you'll have to double the amount that you're going to put away to do that. So $200 a month would yield you about $27,000, where $100 a month at age 18, or sorry, at zero age to age 18 would run you about $35,000. So it's important to remember those numbers, and important to start as soon as you can. Like everything, when we talk about planning and budgeting, you have to deal with your priorities first, and that's where coming in with a budget and learning what those priorities are is really going to be helpful. So RESP, I let the cat out of the bag earlier when we were talking, is the Registered Education Savings Plan. It's an educational investment vehicle. Contributions, unlike RRSPs, are not tax deductible. However, the investment growth is tax sheltered. And then the investment growth portion of the withdrawal is taxed in the child's hands when it comes out. We're going to talk about what happens if they don't go to school. But if they go to school, that portion is taxed in the child's hands. And presumably, if they're going to school right out of high school, they're not earning a lot of income, so they're not going to be attracting a lot of tax on those dollars. So an RESP can be used for anything in relation to education. So tuition costs, books and lab fees, room and board, equipment, travel expenses related to attendance. Nobody monitors that. So if you've been the subscriber, and that's what they call the person that sets the account up, and your beneficiary, your child or grandchild, are going off to school, you only need to prove attendance at that school, and there's a certain specific document that needs to be provided, and then money will be released. We don't monitor it. The government does not monitor it. As long as they're registered at that institution and they've confirmed they're going, the money's going to flow. So in my practice, what we normally see is that people will come in August or early September, and then again in January, usually of the following year, to fund each semester. I don't suggest you do it on a month-by-month basis. You take out a lump sum, and then you either let the child have access to the money and learn to budget, or you dole it out as you see fit. But we only redeem usually twice a year. Assistance is provided for full and part-time post-secondary education through RESPs, and it can be a college, can be a university, it can be an apprenticeship, it can be trade schools, it can be just about anything that qualifies. It cannot be upgrading. So if your son or daughter has not completed high school and they need to get a few extra credits and they're going to a community college to do so, that's not going to be eligible for it. Though those things could change in the future as well. So there's a number of different RESP plans. We're going to talk tonight about non-contractual plans. Non-contractual plans are plans where you can set up through most financial institutions and insurance companies, and you can make contributions either on a regular basis, such as a monthly withdrawal, or semi-annual, or irregular basis, throw money in as they get it for Christmas presents or birthday presents. That's a non-contractual. A contractual plan, which I'm not going to talk to you about tonight, but that's a plan where you commit to a certain number of dollars every month, month in and month out, for a certain period of time. Again, I'm not going to talk any more than that about it. They are out there and you need to be aware of how they operate. In our case, we have individual plans and we have family plans. An individual plan where you name one beneficiary on the plan, and there can be no relationship between the subscriber and beneficiaries required. So it could be an aunt or an uncle, it could be someone else. You just have to have the permission of the custodial parent in order to establish them. A family plan, applicant must be related to the beneficiary by blood. Grant money is transferable to other beneficiaries within the same plan. So if you have 2 or 3 children in the plan and one of them decides not to go to school, then you can transfer the grant money to the ones that are going to school. You can do that with an individual plan as well. It just requires a little more paperwork because you have to roll it into a family plan. And you can name one or more beneficiaries. So if you've got a large family, you can put every one of the children on there. If you've got only one, you can do that. Quite often in my practice, what I've seen is that folks will do the individual plans because every child has maybe different godparents who want to, or in blended families, they can have a different set of parents and a different set of aunts and uncles. And so everybody wants to give a little bit differently. So you can track the money on deposit to those accounts on an individual basis. Group plans I've never had much to do with, but it's much like a group RSP or any group pension plan. It's a long-term contract. There's regular contributions according to a contract, and penalties and interest may apply if missed contributions or the contract is canceled. Don't see very much of those. Like I say, in my 27 years, I've never seen one. So when you're shopping RSPs or RESPs, I'm sorry, these are some of the questions you may want to ask yourself. Now, I frankly, again, in my number of years of doing this, I've never had many people come in and ask me about different fees associated with RESPs. So far as I know, they're all pretty much standard. The one thing that you will find between different institutions is some will market or carry RESPs that will be invested in a GIC product, a guaranteed investment certificate. Others, such as ours, we only invest in mutual funds. So if you're not particularly enamored with a mutual fund investment, then you'll have to go seek out one of those GIC types of vehicles. So what fees are you expected to pay, and when, if any? Do you have a choice between when and how much you can contribute? What kinds of post-secondary programs qualify? Again, in ours, I know that pretty much everything does. How and when will you receive your payments? In our case, you make application, You provide the document to prove enrollment, and normally within a week or 10 days, you have the money. What if the student does not go to post-secondary education or does not complete their program? What happens? So again, different plans can have different rules. In our case, the money can flow back to other qualified beneficiaries if that's what you want. And if you sign up for a plan and change your mind, normally there is a time period that you can get out of these plans if you enter them. It's not something I would suggest that you enter into willy-nilly. Just like any savings plan, you want to make sure that you can see your way clear to fund it for a while, and then enroll. So all registered education savings plans must mature and be terminated 35 years after the end of the year in which the contract was entered into. So if you've started it for your child when they were just recently born in their first year of life, then 35 years from there, so they're going to be 35 going on 36, they have to have completed the use of their RESP. If they haven't, it will be collapsed. You have any number of options at that point. The principal can come back to you, or you can allow the principal to go to the child. The earnings will go, if they were in post-secondary attendance, the earnings would go to them and be taxed. If they weren't, then the grant money will go back to the government, and then the earnings you can either roll into your RESP or your RRSP or your tax-free savings account, whichever works best for you. Those are all things that we would detail at the time of opening the plan. So RES contributions can be made up to the earliest of. So for families and single plans, they're all pretty much the same. You can see that the beneficiary turns 31, you can make contributions. You only get granted, though. This is what most people are most concerned with. You're only granted from the government. The Canada Education Savings Grant is only granted to the end of the year in which the beneficiary turns age 17. So if you've got a child that you haven't got an RESP for and they're 16 years old, you're not going to be eligible. I think that comes up later in this discussion to open one. They have to have been contributing prior to the age 15. If transfers have been made to the plan 31 years after the year of the earliest effective date that applies, so that, of course, it will work in both family or single plans. So what that's saying is you can transfer between plans. They all must be terminated by the end of the 35th year, and the lifetime maximum contribution limit per beneficiary is $50,000. You are, however, only ever going to get a maximum grant per beneficiary of $7,200. So here's how it works. So the grant, Canada Education Savings Grant, is payable on the first $2,500 per year of registered education savings plan contributions per beneficiary. So if you've got 3 children in a plan, you can contribute $7,500 per year, and you can get the maximum 20% grant, which is $500 per year per child. So $2,500 triggers the maximum grant. Remember me telling you right at the very start, when that $200 figure was there, if you fund right just around that $200 mark, you'll be getting the maximum benefit. So maximum grant per beneficiary, if you've done it from day 0 to the end of the year in which they turn age 17, you're going to receive $7,200. And grant, as I've already said, is available till the end of the calendar year in which the child turns age 17. Just like our RSPs and just like tax-free savings accounts, unused grant room can be carried forward and used when additional contributions are made in future years. So if your child is 5 years old and you haven't started an RESP yet, or 10 years old or 12 years old, you can start it up and you can max fund these plans and go back and get as much grant as you can in any given calendar year. So we're always able to go back and collect 1 year. So if you just opened this up and you've got a number of years carried forward, you can contribute $5,000 per child. So $2,500 is the maximum grant for 1 year, but you can go back and get one from the previous year. So you could put $5,000 in, get this year's grant, go back and get last year's grant. Then next year you can put in another $5,000, get the grant for that year, and go back and get the 2-year previous grant. So you can always build it back up. So this slide just illustrates the difference that the RESP grant makes. And at this point, I'm just going to say that there's, in my humble opinion, if you want to save for your child's education, there's no good reason not to do an RESP. If they don't go to school, you can get all the money out. The only thing that's left is the grant, and that's going to go back. It will be paid back. We're going to talk about that in a minute. But what this shows is that given the difference between making the same contributions with the Canada Education Savings Grant versus without the Canada Education Savings Grant, again, assuming a 5% rate of return on your money and an 18-year investment period, there's a difference of between $81,000 and $69,000, almost $70,000, so $11,000 difference. And that's $11,000 that, based on those earlier numbers, that could go to the first year's tuition. So basically, you've got yourself an extra year of tuition by using the grant. Okay. So the grant is available if the child is a Canadian resident, the RESP has been opened in their name, and then the provider or the person that's marketed the RESP to you, normally it's their responsibility to get you to complete the grant forms and submit them on your behalf. Certainly that's the case in our case, and then our fund companies apply for the grant on your behalf. So you don't need to do anything other than sign your name. Grant is available again up until the end of the year in which the child turns 17. So 20% payment on eligible contributions. So basically a 20% return on your money in the first year. The investment grows tax shielded and then is payable in the child's hands. Looks like we've doubled up some slides here. So this just shows you a little bit in a little different manner what we showed you earlier, the cost of students to go to school if they're living at home, but calculating in the Canada Education Savings Grant to save that amount of money, how much it reduces your payments by. So if you've got 10 years before your child goes to school, so your child's 8 years old, your estimated cost is $30,000. You want to be able to provide all of it. The monthly savings required at a 5% rate of return would be $250. By the time you calculate in the grant, then your monthly investment would be about 110. So it's greatly reduces your contribution. So this is the question I get all the time. So if you've got more than one child, you can change the beneficiary or you can roll it into a family RESP plan so as not to lose the grant money if the first child doesn't go to university. You can withdraw the money that you've put in and tax-free, and then the income can come out, and again, it can go to the child or it can go to you and you'll pay tax on it. You can donate that money to the educational institution if you're so inclined, or you can transfer the income into your own RRSP. So the options are many and varied. You're not going to lose it in a non-contractual RESP plan. There are some plans where there is penalties applied, and you need to make sure that you understand how those work if you're in one of those plans. So to transfer from an RESP to a personal RRSP, you can transfer up to $50,000. The Canada Education Savings Grant, if the child doesn't go to school, always goes back to the government. The interest on the grant, though, you get to keep, so the government only takes back their principal, and then a T4A and contribution receipt will be issued to you upon transferring it over to your own RRSP. Haven't seen that happen very much over the years, but it does happen. So if you're not a fan of the Canada Education Savings Grant and you don't have any interest in completing the forms to do that, another method to save is the tax-free savings account. So a tax-free savings account for any child under 18 isn't going to work because they're not eligible to have it in their name. However, if you haven't used your tax-free savings account room, then, and I have clients that have done this, they set up their tax-free savings account, even though they can't put the child's name on the account, they can make them the beneficiary if they wish. There's reasons why you would and why you wouldn't, but they label in their own records that that's what the money's for. So the money that's invested, just like an RESP, will grow tax shielded. The difference is when it comes out, it will all come out tax-free. So there will be no tax attracted to it. So you're not going to get any grant for putting money into it, but you're also not going to be subject to any tax. So if I'm saving, for example, if I'm saving for my grandson and I do it through a tax-free savings account, and I've saved, pick a number. Let's say I've saved $50,000 with the rates of return added in, and my grandson turns 18, I can give him the whole $50,000. It's tax-free to me. It's also tax-free to him. And then he can go do with it what he wishes. So there's no right and there's no wrong. I would question why you wouldn't use an RESP for the grant, but certainly a tax-free savings account would work well for that purpose as well. So we did see this slide or something similar to this last week or the week before, and that's tax-free savings accounts versus non-registered savings. So in this particular scenario, it's a $200 monthly contribution, again, a 5% rate of return on investment, and a 20-year investment period. So if you're putting that money into a non-registered account, so just a conventional savings account, you're going to have contributed $48,000. But the money that is earned in this account is taxed every year. So it's taxed at your marginal tax rate, whatever that is. So in this scenario, and it doesn't tell us which marginal tax rate, but we're going to assume it's about a 30%, you're only going to have a growth of about, well, not only, you'll have a growth of about $25,000 on your $48,000 investment. Whereas if you do the same thing in a tax-free savings account, you contribute the same $48,000, but when you don't have to pay any tax on it, that $25,000 becomes $34,000. So you've got a tax savings of about $9,500. If you've heard me speak before on these matters, unless there's a very good reason, there is no good reason not to save in a tax-free savings account. If you're a U.S. citizen, that causes some complications, certainly. But for everyone else, if you're not utilizing your tax-free savings account, whether it be for educational purposes or your own, you need to really consider that. And inside a tax-free savings account, to answer that question first before it's asked, you can have any number of different investment vehicles. So you can have a GIC, you could have mutual funds, you can have individual stocks, or a combination thereof. Okay. Look at that. We're almost finished. I told Sam that I thought we would take just about 45 minutes, but we're not going to get there. So today we discussed the importance of preparing for increased educational fees. And again, the information that I've provided, you can Google it up on RESPs. You can go to your favorite financial institution and ask them the questions, or you can fire me an email or give me a call at my office, and I'm happy to answer those questions for you. I can explain to you how the RESPs work, the Canada Education Savings Plans, and the tax-free savings accounts. So like always, we end these things by summing up. The first thing you need to do is to make a plan, whether it's to save for education or for your own retirement or just to be able to live from month to month. Then you need to plan for the change, and hopefully you can reach your goals. With that, if you've got any feedback, questions, concerns, I'm happy to hear them. And this here is my contact information. So feel free to give me a shout at any of those numbers or that email address anytime if you've got questions or concerns on RESPs or any other investment vehicles or financial planning matters. Thank you very much.